I don't trade every pattern. I trade one. The same setup has paid me for years because it appears before every real move. It's not on a chart. It's in the behavior of the market itself. Once you see it, you can't unsee it, and you'll never chase again. In this lesson, I'm going to show you how I know when a stock is ready to move. You'll learn the one pattern I trust with my own capital, the signal that tells me the waiting is over. Most traders guess. They rush in. They let price fool them. I'll show you how to read the market's rhythm so you know when to strike, not just what to buy. By the end, you'll understand why time, not price, is the real secret behind every great move. I know what it feels like to watch a stock move without you. You sit there, watching it rise, thinking, if only I'd bought. Then, when you finally act, the move is already over. I've done that. I lost more from being early and impatient than from being wrong. The truth is, most traders never learn to wait. They think the market rewards speed. It doesn't. It rewards timing, and timing comes from study, patience, and observation. That's what I'll teach you here. Not how to predict, how to wait until the market confirms your judgment. In this video, I'll break down my law of timing, the simple way I know when a stock is ready to move. We'll talk about how to read the market's behavior, how to tell when the crowd is finished, and how to know when the real move is starting. I'll show you why the biggest profits come not from thinking but from sitting. You'll see the pattern that repeats before every strong advance and every sharp decline. And before we're done, I'll open the loop. You must never close the patience to wait for confirmation, because once you learn that, you'll never again confuse movement with opportunity. Most traders walk into the market blind. They look at a chart and see prices moving up and down like the heartbeat of chance. But the market's never random. It leaves footprints clear as tracks in fresh snow if you slow down long enough to look. Here's something most people completely miss. A stock never moves by surprise. It prepares. It builds pressure. It tests your patience. Then, when it's ready, it moves like a man who's been holding his breath too long. I learned that the hard way. Early in my career, I thought movement meant opportunity. I'd see a rise, jump in, and the market would slap me like a tide that changed direction the moment my foot touched the water. What I finally learned is that price only tells you what's happened. Time tells you when it's ready to happen again. The real signal isn't in the motion, it's in the pause before the motion. That pause is the market inhaling. And if you listen close, you can hear it. When I was young, I'd spend mornings watching a handful of stocks that seemed dead. No chatter, no excitement, just quiet. But I noticed something. When the crowd ignored them, volume started to hum, barely audible. Then one day, they'd come alive. Those were the moments I waited for, the quiet before the thunder. That's how I made some of my biggest trades. In 1907, when the panic hit, the whole street was screaming fear. But I'd been studying those quiet stocks for weeks. They were telling me the truth long before the papers did. While the crowd panicked, I was already positioned. When the storm passed, I was standing on dry ground, counting profits. Now, don't mistake quiet for safety or noise for danger. What matters is how a stock behaves, not what anyone says about it. Watch how it reacts to news. If bad headlines can't drive it down, that stock's strong. If good news can't lift it, it's weak. The tape whispers long before it shouts. Think of it like this. The strongest markets rise on quiet days, when no one's watching. The weakest fall without a headline in sight. The truth hides in silence. So before I ever make a move, I ask myself, what's the market doing when nobody's looking? Because that's where the next move is born. Once I know what the market is whispering, my job is simple: listen longer than anyone else. And when that whisper turns steady, I know it's almost time. But patience isn't easy. Waiting feels like weakness to most men. They confuse activity with progress. I used to, too. Until I realized that the market doesn't reward action, it rewards readiness. And that brings me to my next rule: patience is the proof of readiness. Every morning before the market opened, I began my work long before the noise started. That quiet time was my edge. While most traders were rushing through the papers or arguing over rumors, I sat alone, studying. I'd read the small news, the forgotten pieces buried under the bold headlines, the three-line stories that others ignored. Those tiny lines often carried the seeds of major movements. You see, The market rarely announces its intentions in the front page, or the evening gossip, it hides them in the details. I treated that morning hour as sacred because it was the only part of the day when the market couldn't talk back to me. It was my time to think, not react. I'd review world conditions, business reports, crop yields, railroad earnings, anything that could shift human behavior in the days ahead. Most men think trading begins when the bell rings. They're wrong. Trading begins in the quiet, in that hour of preparation when you decide not just what you might trade, but what you must ignore. Here's something that surprises most people. Half my success came from what I refused to touch. A good trader doesn't need more opportunities, he needs fewer temptations. Every day, I'd build a list of stocks I would not trade no matter what happened. If a stock didn't act right in its group, if it was full of erratic motion, or if it was too popular in the stock morning papers, I crossed it off. Discipline isn't about holding on, it's about letting go of noise before it touches your judgment. I insulated myself from bad influences. I never sat in brokerage houses after my first lessons as a boy. I learned that most talk in those rooms was poison wrapped in excitement. I preferred solitude. The moment you let another man's opinion become louder than the market itself, you're lost. So each morning, before I ever thought about a single trade, I cleared my mind. I checked my notes, reviewed my records, and reminded myself of one rule. I trade only when the market gives permission. My notebook was my truth. I'd write down each stock, its range, its volume, its behavior over days and weeks, and how it acted when it hit certain prices. Those records were the fingerprints of the market. Without them, I was guessing, and guessing has no place in speculation. Over time, those notebooks became my most valuable possession. They showed me the rhythm of stocks, their temperament, their habits, their reactions. A trader who keeps records learns the market's language. A trader who doesn't is deaf. But preparation isn't just studying numbers, it's shaping your own mind. Each morning, I reminded myself not to hope, not to fear, not to rush. Hope and fear are twin thieves that rob a man before he even trades. I had to walk into the day ready to act, but willing to wait. The crowd wants action. The professional waits for confirmation. The amateur looks for reasons to trade. I looked for reasons not to. That's how you conserve your capital and your confidence. If you walked into my office back then, you wouldn't find noise or excitement. You'd find silence and focus. The blinds drawn, the ticker isolated, my chair facing away from distractions. I didn't want the market to invade me. I wanted to enter it on my terms. By the time the first quote came through, I already knew which stocks were likely to lead, which sectors were in favor, and which stories were bait for fools. I didn't need to chase anything. I had already decided what I'd do and what I'd ignore. Preparation builds the map, and every map is useless without knowing when to start the journey. But once I've done the work, once I've studied the terrain, I wait. I wait for the signal, the sign that tells me time and price are finally shaking hands. That's when the market reveals it's ready to move. And when that happens, the work of waiting turns into the art of timing. That's the next law, the one most traders never master, because it asks for something they hate to give: patience. You can read 1,000 charts. You can memorize every price. But until you understand how to wait for the moment, you'll never truly trade. So let's talk about it, the law of timing, and how I know when to strike. Here's something that took me half a lifetime to learn. In speculation, price is only the echo. Time is the voice. Every movement in the market, every surge and slump, begins long before you see it on the tape. It begins quietly, invisibly, as forces build and shift beneath the surface. The crowd looks only at price because that's all they can measure. But the professional watches time the way a stock behaves, rests, breathes, and gathers strength between moves. Most traders think of time as the enemy, something that erodes patience and opportunities. I think of it as the soil. Nothing grows without it. You can't force the market to move any more than you can hurry the seasons. A stock, like nature itself, has its periods of planting and harvest. If you want to reap, you must first wait through the quiet months when nothing seems to happen. That waiting period is where the real move is born. When I speak of time, I'm not talking about clocks or calendars. I mean the natural rhythm between accumulation and distribution, the invisible clock of human emotion. There are moments when the market must pause not because it wants to, but because the traders who drive it are exhausted, confused, or overcommitted. When everyone has bought who can buy, the market must rest. When everyone has sold who can sell, the market must rest again. That rest is not failure, it's preparation. It's energy being gathered for the next great swing. And if you can read that rhythm, you can sit quietly while others waste their money guessing which tick marks the turn. You'll know that nothing new ever really happens in speculation. The same patterns repeat because people repeat. Greed, fear, hope, pride, they never change. Only the names on the ticker do. I used to study stocks the way a farmer studies the weather. There were times when I could sense a change in the air, not because of any single event, but because the whole atmosphere shifted. I'd see volume dry up, reactions grow shallow, and volatility flatten like the calm before a storm. Those moments told me more than any headline could. They said, "Wait, the market is loading the spring." When I saw that, I didn't rush in. I stayed still. The temptation to anticipate is the curse of most traders. They want to be the first in, to catch every move from the start. But time doesn't reward the first, it rewards the most patient. I've made more money waiting for confirmation than I ever did trying to guess the turn. Look at steel, cotton, or rails. Any great move I ever caught came only after the market had been dull for weeks. People complain when the market's quiet, but that's the best signal there is. Dullness is the disguise of accumulation. It's the market drawing breath. And just when the crowd gives up, when they say there's nothing left to do, that's when the move begins. I remember how cotton sat lifeless, trading in narrow ranges, everyone bored and half asleep. But I watched the clock, not the noise. The time element told me the movement was overdue. When it came, it didn't creep, it exploded. That's the nature of time. It compresses energy, then releases it all at once. So when I say time, I'm really talking about the maturity of opportunity. A stock that's ready to move feels different. You'll notice smaller reactions, stronger recoveries, steadier tone. It's like watching the tide roll in. You don't see it jump. You see it rise quietly, irresistibly. And once you've trained your eye to spot that rhythm, you'll never be fooled by sudden motion again. You'll know the difference between a stir and a shift, between noise and signal. Waiting is hard because it feels unprofitable. Men want to see something happening with their money. They think sitting still means missing out. But the truth is, when you learn to wait for the right moment, you stop losing to the wrong ones. Time is the invisible law that governs every trade. Break it, and the market will break you. Respect it, and you'll begin to see what others never will: the calm before the storm, the quiet before the move, the breath before the shout. And once you can see that, you're no longer chasing prices, you're aligning with inevitability. That's what timing really is. It's not prediction, it's recognition. It's seeing the energy before it bursts. Now, knowing when the market's ripe is one thing, but how do you spot that first pulse? That first real motion before the crowd even knows it's begun? That's the next step. Because once I see that, I don't guess anymore, I know. There comes a moment when all the watching, all the waiting, all the quiet discipline suddenly pays off. Not because the market gives you a sign written in lights, but because something subtle changes in its behavior. It's like the shift in the air before rain, or the way a horse flares its nostrils before it runs. The signs are small, almost invisible, but to the trained observer they speak louder than any headline. That's what I mean when I say the stock begins to act right. It's not magic, and it's not luck. It's the market revealing its intention to those who've been patient enough to listen. Most traders miss it because they're looking for proof. They want the move to be obvious before they act, and by the time it's obvious, it's already over. But the market doesn't shout, it hints. The hint is everything. A stock that's ready to move starts to breathe differently. You'll notice its reactions shrink, its recoveries strengthen, and its tone steady. One day it dips a little, then springs back faster than it fell. The next day it tests the same level and refuses to break. The volume grows not wildly but honestly. There's firmness in its trading, as though some invisible hand is supporting it quietly, persistently. That's the time I begin to pay close attention, because that's when the character of the stock changes. You can almost feel it saying, "I'm ready." It's the same in life. Before anything great happens, there's always a quiet rehearsal, a subtle tightening of energy before release. Let me give you an example. Before the Northern Pacific corner of 1901, I watched that stock for weeks. Everyone else was chasing the glamour stocks of the day, the noisy ones that made headlines and broke hearts. But Northern Pacific had a different feel. It wasn't leaping, it was building. The reactions were small, the rallies sharp. It was acting right. I didn't know who was behind it, and I didn't need to. All I needed to see was how it behaved under pressure. When bad news came, it didn't fall apart. When the rest of the list weakened, it held firm. That's the kind of strength that tells you there's a real move, forming quiet, deliberate, and unstoppable once it begins. Most people think they can outsmart the market by predicting what should happen. That's where they fail. The market doesn't pay for your opinions. It pays for your obedience. It rewards those who can see what is happening and act accordingly. I never cared why a stock was acting right. Maybe it was inside buying. Maybe it was a shift in demand. Maybe it was simply the exhaustion of sellers. The cause never mattered as much as the behavior. The tape tells you everything you need to know if you can learn to stop arguing with it. When the market says it's ready, believe it. When it says it's not, don't try to convince it otherwise. You see, there's a rhythm to a healthy move. It's like a man climbing stairs. He doesn't leap to the top. He rises step by step, pausing just enough to catch his breath, but never slipping back too far. That's what I call normal reactions. When a stock's rising naturally, it will rest, retrace a little, and then move again. Those rests are not weakness, they're strength. They show control, order, confidence. But when the steps suddenly turn into jumps and drops, when volatility spreads like fever, that's your first warning that the move is aging, not starting. Learn to tell the difference between a stock that's marching and one that's stumbling. I once watched a stock that looked perfect on paper. The charts were bullish, the news was bright, and the crowd was singing its praises. But the action was wrong. Each rally faded faster than the one before it. Each dip cut deeper. The rhythm was broken. I stayed out. Within days, it collapsed. The crowd never forgave it. But the market didn't need forgiveness, it had simply finished its move. When a stock stops acting right, that's your cue to stand aside, no matter how tempting the story looks. Remember this: your job isn't to trade stories, it's to trade behavior. And behavior never lies. When a stock acts right, you'll know it the same way. You know when a person means what they say. It's not in the words, it's in the tone. You'll see it in the volume, the steadiness, the way it responds to pressure. A weak stock flinches at bad news. A strong one shrugs it off. A weak stock surges on gossip and fades on silence. A strong one rises when no one's watching. The market is a mirror. It reflects conviction and exposes doubt. Learn to read that reflection, and you'll see the move forming before it takes shape. Now, here's where discipline comes in. When I sense that change, when a stock begins to act right, I don't rush in with both hands. I don't throw capital at the first signal. I test it. I probe the market the way a doctor tests a pulse. A small trade, a small risk. Not to make money, but to ask the market a question. Are you ready? If the stock answers yes, if it gives me profit right from the start, then I know I've found my moment. If it hesitates, if it fades, I step aside. No arguments, no ego, no second guessing. The market never lies. Opinions do. The crowd can't stand this kind of patience. They think it's cowardice to move small. They forget that the real power in speculation lies in restraint. I've made fortunes with small beginnings because I waited for the market to prove me right before I grew bold. That's the secret behind every big campaign I ever ran. You can't control the market, but you can control yourself, and that's enough. So the next time you watch a stock that seems asleep, remember, sleep is not death, it's rest. And when that rest ends, it won't whisper, it will move. But you'll only hear that movement if you've trained yourself to recognize the sound of strength before the crowd does. And once you've found it, once you've confirmed it, that's when the real game begins. Because the tell is only the beginning. The test is what comes next. When I first began to understand the market's rhythm, I realized that reading it wasn't enough. You could study for years. You could fill notebooks with figures. But all that knowledge meant nothing until you tested it in real time. The market doesn't care about your theories. It listens only to action. And so I began to think of every trade not as a gamble, not even as an investment, but as a question I asked the market, and one the market always answered. That question was simple. Am I right? But the only way to get an honest answer was to risk a little something. The act of trading was the test, the probe, the experiment that revealed truth. I called it taking the market's pulse, because that's exactly what it was, a small touch, a feel for its heartbeat before making a commitment. Whenever I sensed a stock beginning to act right, I'd put on a small position. I wasn't looking to make money from that first trade. I was looking for information. I wanted to know if the market would reward my judgment or reject it. If the stock moved in my favor almost immediately, that was confirmation, like feeling a steady, strong pulse beneath your fingertips. If it hesitated, if it sagged or struggled, I closed it out without hesitation. I didn't need to see how the story ended. The answer was already there. The market was saying, not yet. That small test saved me from countless heavy losses because it kept me from mistaking potential for certainty. I learned that when the market wants you to make money, it helps you. The right trade feels right because it works right from the start. You buy, and the stock begins to rise as if it's been waiting for you. You sell, and it falls as though relieved you finally joined it. That's what I mean when I say the market confirms you. You don't have to force anything. The wrong trade, on the other hand, always feels like work. You enter, and the price just hangs there, heavy, lifeless, uncertain. Or worse, it turns against you immediately, nibbling away at your margin, daring you to justify your stubbornness. That's the moment most traders fail. They start to hope. They wait for luck to save them. But hope has no place in speculation. Hope belongs to men who buy lottery tickets. The market doesn't pay for hope. It pays for discipline. There were times I forgot that rule, and every time I did, I paid. I remember one trade in Union Pacific early in my career. I was sure I'd read it right. The stock had been quiet for weeks, trading in narrow ranges, showing the kind of firm action that precedes a move. I took a small position as a test. The next day it dipped slightly. I told myself it was only a natural reaction. Then it slipped again, just enough to make me uncomfortable. I could feel my pride arguing with my judgment. I told myself, it's fine, it's just shaking out the weak hands. That was a lie, and I knew it. The market was showing me I was early. The test had failed, but I let my ego run the trade. Within days, I was forced to take a full loss. That lesson cost me real money, but it bought me something far more valuable: respect for the market's answers. When I talk about testing, I'm really talking about humility. The probe keeps you honest. It forces you to listen instead of command. Most traders come to the market like generals. They want to lead the charge, but the market doesn't follow anyone. The best you can do is align yourself with it. A small test position is your way of asking permission to participate, and like any good student, you wait for the teacher's nod before you speak again. If the market nods, you stay. If it shakes its head, you leave. Simple as that. Over the years, I began to think of the test trade as the bridge between observation and commitment. It's that moment when waiting becomes action, but not recklessness. It's controlled curiosity. When the market answers yes, that's your cue to build. You add slowly, carefully, each addition smaller than the last, always after the market proves it can carry the weight. But that's the next law, the law of action. The test prepares you for it. Without testing, every trade is blind. With it, every trade becomes guided by experience. And here's the real beauty of it. Testing keeps your losses small and your confidence intact. If your idea is wrong, the market tells you quickly before you're trapped. If it's right, the profits start immediately, and you can sit back knowing you're in harmony with the move. That sense of harmony, that alignment between your judgment and the market's behavior, is the only real confidence in speculation. Everything else is guesswork. So when a stock begins to act right, don't rush to bet big. Don't try to make your fortune on the first move. Place your probe. Ask your question. Let the market answer. And when it does, believe it. Because once you've confirmed the pulse, once the heartbeat is steady and strong, you'll know it's time to act, not test. That's when the waiting ends and the real campaign begins. That's when patience turns to power and small trades become large positions. There's a moment in every great trade when the quiet breaks. The days of patience and watching give way to a single heartbeat of clarity. And if you're ready, that's when you move. Most traders talk about courage as if it's the will to take risk. But real courage isn't about boldness, it's about timing. It's the ability to act when your preparation and your conviction finally align. You can spend weeks, even months, studying a stock, recording its movements, feeling its rhythm, watching for that sign of strength, and then one morning the signal comes. The price breaks through a level it hasn't touched in months. The volume expands, not wildly, but with confidence. It's as if the stock has decided to prove you right. That's when I move. No hesitation, no second guessing. The best trades of my life started with that moment, one clear signal, one decisive action, and no wasted motion. You see, the difference between winning and losing isn't knowledge, it's execution. Most men know what they should do. They've seen enough markets to recognize the same old patterns. But when the moment arrives, they freeze. They tell themselves they'll wait for a better entry or a little more confirmation. What they're really waiting for is permission to avoid fear. But fear doesn't leave the room just because you hesitate. The market punishes hesitation far more than it punishes mistakes. Once the signal comes, if you delay, the move gets away from you. The clarity fades, your judgment weakens, and by the time you convince yourself again, you're chasing, not leading. I've seen more traders lose their nerve at the exact moment they were right than any other time. When a stock confirms your analysis, when it starts to move as you expected, that's when the work of waiting turns into the work of acting. You must move like a soldier who's trained for the order. It's not impulsive, it's instinct born of repetition. When I was young, I didn't understand this. I would see a breakout, hesitate, tell myself I'd buy on the next reaction, and then watch the price climb beyond reach. Then, out of frustration, I'd jump in late and get caught in the first reversal. It took me years to realize that hesitation was the costliest habit a trader can have. Once the market confirms, act immediately. The price you see is the price that's right. But here's what separates professionals from gamblers. Acting doesn't mean guessing. It means committing to a plan that's already proven by behavior. When I enter a trade, I know in advance where I'll be wrong, and I accept that possibility without emotion. That's why I never average down. Adding to a losing position isn't courage, it's ego. The market's already told you you're wrong. Why argue? Take the small loss, clear your head, and wait for the next real signal. If the move is genuine, there will be plenty of room to profit. The amateur spends his energy defending mistakes. The professional spends his energy waiting for opportunities. In 1907, during the Great Panic, I learned how quickly the line between waiting and acting can change. I was short when the market collapsed, and I made a fortune while others were ruined. But here's what few people know: I was ready to reverse at any moment. While the whole street was frozen in fear, I watched for signs that selling pressure was weakening. One morning, after days of panic, I noticed that the market refused to break further. Selling was exhausted. The ticker told me the truth before the headlines did. Within hours, I reversed my position and went long. That one decision, made not from hope, but from readiness, earned me more than all the waiting that came before it. Acting at the right time is worth more than being right at the wrong time. You can't think your way into perfect timing. You can only prepare yourself to recognize it when it arrives. That's why discipline in the waiting period is so critical. When you've done your studying, when you've written your records, when you've cleared the noise from your head, action becomes easy. The decision is already made long before you pull the trigger. Acting is just the final motion of patience. The market pays for that kind of clarity. It rewards the trader who moves without hesitation because he's been waiting with purpose. But even when the timing is right, you must remember that one good action doesn't make a campaign. Acting once is the beginning of the move, not the mastery of it. Managing that action, knowing when to press, when to hold, when to take partial profits, that's where the real art lives. A great move isn't captured by one trade. It's built in stages, each one earned by the market confirming your judgment again and again. The key is to add only when the market pays you to add. That's how I've always done it. I never build a position on hope, only on profit. And that brings me to the method that turns small beginnings into great. Fortune's the pyramid. It's not about greed, it's about precision. Because in speculation, you must never assume you're right. You must make the market prove you right again and again. The secret of building real profits is not in size, but in sequence. Most traders think they need to trade bigger to win bigger, but that's the quickest road to ruin. You don't build wealth by swinging harder, you build it by letting the market lift you, one layer at a time. That's what I learned through years of trial, loss, and observation. A single correct trade means nothing if it's not managed correctly. What matters is how you build upon strength without inviting weakness, how you let profits grow without feeding your ego, and how you stay aligned with the market's rhythm as the move unfolds. That's the essence of pyramiding. It's not a trick or a formula. It's a philosophy. It's the discipline of adding only when you've earned the right to, when the market itself gives permission through action, not through hope. When I pyramid, I start small, always small. The first trade is a test, a question I ask the market. If that trade begins to work immediately, if the stock responds as I expected and shows strength instead of hesitation, then I have my answer. That's when I add, but the additions are never equal to the first. Each one must be smaller than the last, because each step up the pyramid carries more risk. I build my position the way an architect builds a tower, broad at the base, narrow at the top. The foundation is proof, the top is refinement. It's a method designed to protect you from overconfidence and from the most dangerous illusion in speculation, the illusion of safety and success. Every time the market pays me, I take a portion of those profits and put them back into the move, never my original capital. That's how I turn the market's money into my leverage. I let the trend finance its own expansion. It's the only way to take in. Grow a position without letting greed erode your judgment. Too many traders do the opposite. They add to losers and cut winners. They nurse pain and kill potential. But if you only add to your profits, the worst thing that can happen is you lose money you never truly owned. That's how you stay in business for decades instead of seasons. I remember my great cotton campaign. It started with one small trade. Nothing grand. The market was sluggish, volume low, and nobody cared about cotton futures. But the time element told me something was building. I took a position. It went my way, slowly but surely. And when I saw that first proof, I added, not recklessly, but with patience. Every addition came only after the market had rested and resumed. It was a steady climb, buy, wait, watch, and add again. By the time the move reached its height, I was sitting on a position that seemed enormous, but it hadn't felt that way while I built it. It felt natural, logical, inevitable. Each step was justified by profit, and when the move ended, when the action began to change, I didn't hesitate. I took my profits and left. That campaign turned into millions. But what mattered most wasn't the money, it was the mastery of restraint that created it. You must understand this. Pyramiding isn't about confidence, it's about control. Every addition must pass the same test as the first. If the market hesitates, you stop. If it reverses, you retreat. Never add to weakness, never argue with action, and never believe you're smarter than the tape. When a trade works, it's not because you're brilliant. It's because the market is aligned with your position, and that alignment is temporary. The moment the market stops confirming, your job is to stop building. Patience is what makes pyramiding work. You can't rush the steps. You must let each new layer settle before placing the next. I've seen men destroy perfect trades by forcing the process. They see a small profit and double up too soon, thinking they're amplifying success. But what they're really doing is exhausting their margin and killing flexibility. The professional trader understands that control is freedom. You want to be in a position where you can always make a decision calmly, without panic. A smaller position that moves in your favor is worth more than a large one that keeps you up at night. Sometimes people ask me how I can sit tight through reactions, through those small setbacks that make the crowd anxious. I tell them it's simple. When you're right, reactions are gifts, not threats. They let you add at better levels while confirming the trend remains intact. A strong market always breathes. It never moves in a straight line. If you panic at every dip, you'll never build anything lasting. But if you can sit through normal reactions, with your pyramid in place and your rules clear, you'll ride moves that others can't even imagine. I've had campaigns where I added 5 or 6 times over the course of months, each addition smaller, each one built on profit, each one tested and confirmed. That's how professionals operate. We don't predict, we respond. We don't bet on what we hope will happen, we build upon what already has. It's a system that rewards discipline and punishes impatience. Every big loss I've ever seen started as a small loss that someone refused to take. Every great fortune I've made started as a small gain I had the patience to build upon. You can think of pyramiding as a conversation with the market. The first trade says, "I believe." The market replies, "You're right." You respond, "Then I'll trust you a little more." The market keeps proving you right, and together, you climb higher. But the moment the market hesitates, the moment it stops answering your confidence with confirmation, you stop speaking. You don't argue. You don't plead. You listen. The silence that follows is your cue to end the conversation. That's how you survive. Even in the middle of action, restraint remains the greatest strength. There's a fine line between boldness and recklessness, and the trader who can't tell the difference won't last long. Pyramiding keeps you honest because it ties your ambition to reality. It forces you to let the market do the heavy lifting. And when the time comes to unwind the pyramid, when the signs of exhaustion appear, you don't hesitate. You take your profits, thank the market, and start preparing for the next quiet period. That's the rhythm of success. Every great trade ends the same way. It begins with patience, discipline, and humility, because even the best position, if mishandled, can turn into disaster. The market doesn't care how long you've been right. It only cares how you behave when you're wrong. And that brings us to the next law, the law that saves you when the market stops being your friend. Because no matter how perfect your timing or how elegant your pyramid, sooner or later, every trader faces the same question. How do you protect what you've built when the market turns against you? Every trader wants to talk about how to make money, but the first rule I ever learned, and the one that kept me alive when better men went broke, is how not to lose it. Small losses are the tuition you pay to stay in the game. Big losses are the cost of leaving it forever. I've watched hundreds of traders destroy themselves not because they lacked intelligence or instinct, but because they refused to take a small loss when it was staring them in the face. They let pride, hope, and ego whisper the same lie. It'll come back. But the market never owes you a recovery. When it turns against you, it's not punishing you, it's warning you. The only question is whether you'll listen. I can still feel the sting of my early mistakes. There was a time when I'd buy a stock at 30, watch it drop to 28, and tell myself it was just a reaction, that it would bounce. Then I'd watch it fall to 26, 24, and suddenly the little scratch had turned into a wound. But I still couldn't sell. Why? Because selling meant admitting I was wrong. That's what pride does. It turns a market lesson into a personal insult. And the more your pride grows, the more expensive your education becomes. I learned the hard way that the first loss is always the best loss. Every point you delay adds another layer of emotion between you and the truth. And once emotions enter the trade, reason leaves the room. Taking a small loss is not failure, it's maintenance. It's the act of cleaning your instrument so it plays true. You cannot speculate successfully if you're carrying the weight of old mistakes. Each loss you refuse to take becomes a stone in your pocket, dragging you deeper every time the tide shifts. A good trader cuts losses the way a surgeon cuts infection cleanly, quickly, without hesitation or remorse, because hesitation is where losses multiply. I've never met a man who went broke taking small losses, but I've met plenty who went broke waiting for a miracle. During the panic of 1901, I made one of those costly errors that burned the lesson into my bones. I'd been short in a stock that refused to break. It hovered stubbornly, showing strength when it should have shown weakness. Everything in the market told me to get out, but I ignored it. I told myself the decline would come any day. When the corner came instead, the stock exploded upward, and I was caught in a rush that nearly wiped me out. The market had warned me a dozen times, but I was too proud to listen. That loss taught me that protection must always come before prediction. The moment the market disproves your idea, you don't argue, you act. You have to think of trading as a business, not a crusade. In business, losses are expenses. They're part of the operation. You wouldn't keep throwing money into a failing venture just to prove you were right about it. You'd close it, write it off, and move on. Trading should be the same. When a trade goes wrong, it's not a moral issue, it's a professional one. Your only duty is to protect your capital so you can fight again tomorrow. I always kept my losses small enough that they couldn't interfere with my judgment or my sleep. If you can't sleep with a position, you've already lost, whether the price moves or not. And here's something most traders never understand. Small losses preserve not just your money, but your clarity. A man holding a losing position can't see the market clearly. Every tick against him becomes personal. He starts interpreting every movement as a threat, every rumor as hope. He stops reading the tape and starts arguing with it. That's when the market destroys him, not because it's cruel, but because it's indifferent. The market doesn't care about your feelings. It only reflects your discipline. I've always said that speculation is a business of self-protection first. Every trade I take begins with one question: where am I wrong? I decide that before I ever decide how much to risk. Once that price is hit, I'm out. No hesitation, no debate. It's not courage to hold on, it's ignorance. The only courage that matters is the courage to face a mistake while it's still small enough to correct. Once you train yourself to act without emotion, to see losses as the cost of doing business, you'll find a strange thing happens. You start losing less. The market stops punishing you because you stop punishing yourself. Pride is the costliest position on Wall Street. The man who can't take a small loss will someday take a large one, and that large one will take him. That's why I tell every trader who asks for advice, guard your capital the way a soldier guards his ammunition. You can't win battles without bullets. Once you've lost your ammunition, all the strategy in the world won't save you. Cutting a loss is an act of respect. Respect for the market, respect for your own judgment, and respect for the law that governs every great speculator. Survival comes before success, because there's no glory in being right once and broke forever. The trader who lasts long enough to learn his lessons is the one who gets to apply them. The man who blows up never gets another chance. Protecting capital is more than cutting losses. It's protecting your mental clarity. You can't read the market through regret. The next law I'm going to share has nothing to do with dollars or percentages. It has to do with your real account, the one inside your head. Because every trade you make doesn't just affect your wallet, it affects your confidence, your composure, your belief in your own judgment. And once that account goes bankrupt, no amount of money can save you. Every trader keeps two accounts, though most only ever look at one. There's the one you can see the figures on the ledger, the dollars and cents, the balance that the broker sends at the end of each day. That's your financial capital. But there's another account, one far more fragile, and it sits between your ears. That's your emotional capital. Lose the first and you can earn it back. Lose the second and you're finished, even if the money's still there. I learned that truth not from books, but from exhaustion, from those long years when every loss felt like a wound and every win felt like relief instead of triumph. A trader's greatest risk isn't bankruptcy, it's burnout. You can rebuild capital with discipline, but once your judgment's been poisoned by frustration, no amount of money will fix it. Every wrong trade takes a little more out of you than it does from your account. It drains confidence quietly, the way water leaks from a cracked pipe slowly, invisibly, until one day the well runs dry. You don't even notice at first. You start second-guessing setups you used to trust. You hesitate when you should act. You act when you should wait. You find yourself needing to be right instead of needing to be disciplined. That's the first sign that your emotional balance is dipping into the red. The irony is that the cure for that fatigue isn't more trading, it's less. The best position you can take after a losing streak isn't in the market, it's in cash. Cash is a position too, but it's one that heals. It gives you space to see clearly again, to let the noise drain out of your head. I remember the summer after a brutal run in 1915 when I'd lost more than I'd care to admit. The market wasn't against me. I was against myself. I'd been trading too often, too emotionally, trying to claw back what I'd lost. Revenge trades, they call them now. Back then I called them desperation. Every night I'd tell myself I'd stop, that I'd wait for the right setup, and every morning I'd sit down at my desk and break that promise. I wasn't trading the market, I was trading my own frustration. One morning, after another losing day, I pushed my chair back, looked at the ticker, and realized I wasn't fit to trade another dime. So I stopped. I took a break, not for days, but for weeks. I walked, read, watched prices from a distance. Slowly, the need to act faded, and when I returned, I saw the market as it was, not as I wished it to be. That pause saved me. It wasn't the market that had been my enemy, it was my exhaustion. That's what I mean by emotional capital. Every decision you make draws from it. Every trade you force drains it. The trader who trades constantly, who fills every quiet hour with action, is like a man burning both ends of a candle and wondering why the light grows dimmer. I've seen brilliant minds turned into wrecks because they couldn't step away. They thought discipline meant persistence, but true discipline often means restraint. It's knowing when. You're no longer thinking clearly and having the sense to stop before the damage spreads. Most traders think they lose because they lack information. They read another book, buy another indicator, follow another expert. But it's not ignorance that kills them. It's fatigue. You can't think straight when your nerves are frayed. You can't see the market when all you're seeing is the echo of your own mistakes. I've always said, a trader's mind is his main capital account. Guard it the way you'd guard gold. Don't let failure corrode it, and don't let success inflate it. Both can destroy you if you don't keep perspective. The market's designed to test your balance, not just your bank balance, but your emotional one too. Every swing, every false breakout, every sudden drop is a question. Are you steady enough to survive this? That's why I value cash more than comfort during rough times. Cash doesn't just preserve money, it preserves confidence. When you're flat, when you're sitting on the sidelines, you can breathe. You can watch the crowd without being part of it. You can think without panic. The man who's overextended can't do that. He's trapped. Every tick against him feels like judgment. That's when bad trades multiply. Not because the market changes, but because he does. He's reacting instead of reasoning. He's gambling instead of speculating. And worst of all, he's teaching himself to associate trading with pain. The desire for constant action is responsible for most losses. That's what I wrote, and it's what I lived. The greatest edge you can develop is the ability to sit still, not just in the market, but in your mind. Most men lose not because they lack a system, but because they can't sit quietly with their thoughts. They trade to escape boredom, to chase excitement, to feel alive. But real traders learn that excitement is poison. When you start to feel it, step back. The best trades rarely make. Your heart race, they make it slow. They feel calm, inevitable, aligned. Anything else is danger disguised as opportunity. You'll know your emotional capital's running low when trading stops feeling like analysis and starts feeling like therapy. When you're using the market to fix something inside you, you've already lost. The cure is not another trade, it's rest. Stop, reflect, reset. Let your emotions settle before they settle your account. When you return, come back with humility, not vengeance. Because the market doesn't remember your losses, but it will punish you for remembering them too long. When your capital and your mind are both safe, you're ready to face the only real opponent you'll ever have in speculation, the crowd. Because it's not the market that breaks most traders. It's the weight of human emotion, multiplied by millions of others who all believe they're different. Understanding that crowd, standing apart from it, and refusing to move when it panics, that's where true independence is born. And that brings me to the next law, the one that explains every boom, every bust, every madness that ever swept through Wall Street, the law of crowd psychology. If you want to understand markets, you have to understand people, because the market is nothing more than human nature written in numbers. Every tick, every swing, every panic and boom, it's all emotion turned into motion. Men like to believe they trade on logic, that they make decisions from facts and reason, but that's the biggest lie on Wall Street. The market is not ruled by logic. It's ruled by fear and greed, and both move faster than thought. That's why prices can rise higher than anyone believes they should and fall further than anyone thinks possible. I learned that lesson early, not from theory, but from standing in the noise and watching the crowd behave like a living creature, breathing, trembling, stampeding from hope to terror and back again. Once you see that rhythm, once you recognize how predictable madness can be, you stop asking why people do what they do and start preparing for when they'll do it again. Fear sells faster than hope buys. It always has. You can feel it in the tape when it hits. The air changes, the chatter sharpens, and men who were boasting of profits yesterday suddenly whisper about ruin. I used to say, the market is like a thermometer of human emotion. It measures not temperature, but temperature swings. The crowd moves together, not because it knows something, but because each man looks to the other for certainty. And when they see fear in one pair of eyes, they feel it in their own bones. Then, like dominoes, they all fall the same way. That's when the professional steps in, not with arrogance, but with calm. Because when the crowd is ruled by fear, prices are ruled by opportunity. I remember the run-up to 1,929. The air was thick with euphoria. Men who couldn't tell a balance sheet from a grocery list were buying stocks like lottery tickets. I'd walk into a broker's office and hear secretaries, cab drivers, and clerks all talking about the next sure thing. It was a fever, and I'd seen it before. The same tone of voice had filled the air before the break of 1,907, before the railroad collapses, before every major panic that followed. There's a rhythm to human confidence. It expands until it bursts. The market doesn't create that pattern. It only reveals it. When everyone believes it can only go up, it's already begun to fall. That's the law of crowd psychology. The more certain the masses become, the closer they are to being wrong. Crowd behavior is cyclical, not random. It follows the same arc again and again. First comes disbelief when prices rise quietly and few dare to believe it's real. Then comes participation when more and more men join in, fearing they'll be left behind. Finally comes conviction when everyone knows it can't go wrong. That's the peak. After that, fear returns faster than it left, and the whole cycle reverses. The wise man studies this rhythm not to predict it, but to prepare for it. You can't fight the crowd's emotion. You can only anticipate its exhaustion. When I shorted into the frenzy before the 1929 crash, people called me a fool. The market's stronger than ever, they said. This time is different. But I'd heard those same words in every mania I'd ever seen. The rhythm never changes. It only changes the faces. I watched volumes swell, volatility widen, and headlines grow more hysterical. Each was a signal that fear was already taking shape beneath the surface. You could feel it building, the unease, the doubt no one dared to say aloud. That's when I knew it was time. And when the break finally came, it was faster and deeper than anyone believed possible. Men who had been millionaires at breakfast were bankrupt by dinner. The same crowd that laughed at caution was now begging for mercy. That's what the crowd does. It swings from madness to despair without stopping at reason. You can't teach it discipline, and you can't argue with it. You can only recognize its signs and step aside before it tramples you. When the crowd's euphoric, I get cautious. When it's terrified, I get interested. That's not contrarianism, it's survival. The market rewards the man who can act when others can't, but only because he's trained himself to think independently of the herd. Most traders will never do that because it's uncomfortable. It feels unnatural to stand alone when everyone around you is certain. That's why you see the same bubbles, the same crashes, the same tears decade after decade. The tools change, the tickers change, but human nature doesn't. A man in 1907 and a man in 2027 will both sell for the same reason: fear of losing what they never really understood in the first place. If you learn to see the market as human emotion given form, you'll stop being surprised by it. The same hand that paints the peaks paints the valleys. When prices soar, it's not a miracle, it's mass delusion. When they crash, it's not tragedy, it's correction. Both are part of the same breath. You can't change the cycle, but you can step outside it. You can stop chasing approval and start listening to truth. And truth in markets is always simple. When everyone's shouting the same thing, they're already wrong. That's the rhythm of fear, the heartbeat of speculation. It beats faster when the crowd is nervous, slower when it's complacent, but it never stops. If you want to make money in markets, you must train yourself not to move to that rhythm, but to listen to it, like a musician who anticipates the next note before it's played. You have to understand the madness without becoming part of it. You have to let the crowd be your teacher, not your guide. And that's why isolation, the discipline of thinking alone, is the next law, because no man can see clearly when he's staring through the eyes of the crowd. No man can see the market clearly when he's surrounded by noise. I learned that lesson early, standing in bucket shops and brokerage offices, hearing the same chatter circle like smoke rumors, predictions, opinions masquerading as facts. It was always the same cycle. A whisper becomes a theory becomes conviction becomes panic, and by the time the truth arrives, the crowd has already destroyed itself. That's why I left the crowd. I didn't hate people. I just couldn't afford to think with them. The mind of the crowd is contagious, and once it touches yours, you start to lose the only advantage a trader ever really has: independence. You begin to trade on emotion, not observation. You stop listening to the market and start listening to men. And men, when gathered in groups, are always wrong at the turning points. I built my office to keep the world out. The blinds were drawn, the ticker isolated behind glass, the phones silent. When visitors came, they often said it felt like a vault. That's exactly what it was. A vault for my judgment, a place where gossip couldn't reach me. I never wanted to hear another man's opinion about what the market should do. I wanted to see what it was doing. My records, my notebooks, my ticker tape, those were my only companions, because they couldn't lie. The tape doesn't flatter you, and it doesn't care about your feelings. It tells you what happened and leaves you to decide what it means. I used to say the market is a mirror. The crowd sees its reflection and mistakes it for the truth, but I learned to look through the mirror and see the people behind it. That's how you stay free. There's a strange kind of peace in isolation. At first, it feels lonely. You miss the hum of voices, the comfort of shared conviction, the illusion of community that comes from belonging to the herd. But once you let go of that need to belong, once you realize the crowd will never make you rich, you start to hear something else: the market itself. Its rhythm, its pauses, its whispers, they become clearer when you stop drowning them in noise. It's like learning to listen to music after years of static. You begin to notice the small things: how volume shifts before a breakout, how a stock resists pressure before an advance, how fear builds slowly before it erupts. These details are invisible to the crowd because they're too busy reacting to each other. But the man who stands apart sees them first. I used to watch traders sit shoulder to shoulder, their eyes glued to the ticker, each one trying to outguess the other. They weren't reading the market, they were reading each other's faces. One man flinched, another sold. One smiled, another bought. It was a chain reaction of emotion masquerading as insight. I could almost see the fear pass from hand to hand like a spark on dry tinder. That's why I walked away. I didn't want to be a link in that chain. When you trade alone, you're forced to face your own weaknesses. You can't blame the crowd for your mistakes, and you can't hide in its noise. You have to take responsibility for every decision. That's the only way to grow. Thinking alone doesn't mean cutting yourself off from the world. It means refusing to let the world make your decisions. I read newspapers, but only for facts, never opinions. I listened to reports, but not predictions. I studied everything I could get my hands on, but I filtered it all through my own judgment. The market rewards the man who can separate signal from sentiment, who can weigh the truth without letting emotion tip the scale. Most traders don't fail because they lack information. They fail because they can't think alone long enough to trust their own analysis. I remember Wyckoff once asked me why I worked in such silence. He said it must be lonely to trade without company. I told him loneliness is cheaper than bad advice. I've paid dearly for listening to others in my early years. A single careless tip cost me more than any deliberate mistake I ever made. The moment you act on someone else's conviction, you've given up your own. You might make money on the trade, but you lose something far more valuable: confidence in your own judgment. And once that's gone, you're finished. You'll spend the rest of your career looking for profits instead of principles, trying to borrow certainty from people who don't have it themselves. You must build your own mental fortress, brick by brick, with experience, observation, and patience. That fortress doesn't protect you from the market. It protects you from yourself. It keeps you calm when the crowd is screaming, disciplined when it's gambling, and rational when it's hysterical. Because the crowd will always scream, and the market will always tempt you to join them. You'll feel it: the pull of excitement, the pressure to act, the fear of missing out. But every time you resist, every time you hold your position while others panic, you strengthen that fortress a little more. I used to tell younger traders that the greatest test of independence isn't when the market moves against you, it's when it moves with you, and the crowd agrees. That's when you have to remember why you entered the trade in the first place. If your reasons were sound, stick with them. If they were borrowed, get out. It's easy to be independent when you're right alone. The real challenge is staying independent when everyone suddenly agrees with you. That's when the crowd's praise becomes dangerous, because it lulls you into thinking you're one of them. But the moment you start thinking like them, you've already lost your edge. I've spent most of my life studying the market's psychology, and here's what I know. The crowd never changes, and neither does the man who learns to stand apart from it. The crowd will always swing between greed and fear, always chase comfort and flee pain, always destroy itself in the pursuit of safety. The independent trader doesn't fight that cycle, he simply refuses to join it. He watches, waits, and acts only when the noise dies down and the signal appears. So when the crowd screams, I grow quiet. When they rush in, I step back. When they panic, I prepare. That silence, that stillness, is not fear, it's freedom. It's the ability to think clearly while others lose their heads. And that's what speculation really demands. Not courage, not luck, but clarity born of solitude. Because in the end, every decision, every trade, every fortune begins and ends with one mind, yours. And that brings me to the final law, the hardest one to live by and the easiest to understand, the law of sitting tight, the mastery of patience. Because even the man who knows how to prepare, time, act, and protect himself will fail if he cannot wait. Patience is the rarest commodity in speculation, and it's the one that costs the most to learn. I spent half my career trying to act, and the other half trying to learn when not to. The truth hit me one afternoon, after years of fighting the tape, chasing every flicker, and losing fortunes to my own impatience. The big money was never made in the buying or the selling, it was made in the sitting. Most traders think that waiting means doing nothing, but that's because they don't understand what waiting really is. Waiting isn't idleness. It's the most deliberate form of discipline a trader can possess. It's the art of staying still while the market works for you, the courage to trust the process you've already prepared for, and the self-control to let your conviction mature into profit. When I say sitting, I don't mean laziness or neglect. I mean the kind of sitting that's rooted in deep understanding, in knowing exactly why you're there and what you're waiting for. Once you've done the hard work studying the trend, testing your entry, protecting your capital, and building your position, there comes a point where your only job is to sit tight, to do nothing. That's where the amateurs fail. They mistake motion for progress, and because they can't stand still, they undo their own success. They'll cut a winning trade short just to feel active again, or they'll jump in and out of the market chasing noise, burning themselves out while the patient man watches. The market rewards the one who waits because waiting requires strength, and most men don't have it. I remember my campaign during the panic of 1907. The world was falling apart, banks were closing their doors, and the papers were shouting doom. I'd taken my position early, built it carefully, and then sat on it through weeks of chaos. Every day, men came to me with advice. Take your profits, Jesse, they said. Don't be greedy. But it wasn't being greedy. I was being disciplined. I knew the move wasn't over, not by the way the market was acting. My charts, my records, my instincts, they all told me the same thing. Sit tight. So I did. I sat through the reactions, the rallies, the false recoveries, all of it. When the real collapse came, I was ready. I didn't have to move because I already had my position. That campaign made me a fortune, not because I was smarter, but because I waited. Sitting is harder than it sounds because it forces you to confront yourself. When you're in a position and the market's moving, every tick becomes a test of your nerve. You start to imagine danger in every pause, opportunity in every ripple. The ticker becomes a drumbeat of temptation. That's where most traders lose the noise, gets inside their heads. They forget why they entered the trade and start trading their own fear instead of the market. I used to pace my office like a caged animal, every fiber of me wanting to do something, anything. But experience taught me that every unnecessary action was a tax on my capital. Every time I interfered with a good position, I made it worse. So I learned to sit, to watch, to breathe. A stock that's acting right doesn't need your help, it needs your patience. You have to let it move on its own time, not yours. The market doesn't move just because you're ready for it to. It moves when the collective psychology of thousands of men finally breaks. That's what you're really waiting for, the moment when human emotion completes its cycle. And that takes time. The market may tease you, testing your resolve with small reversals or dull stretches, but if you've read it correctly, Those pauses are not threats, they're confirmations. They're the market catching its breath before continuing the move. Impatience kills more profits than bad analysis ever did. I've seen traders spend months preparing for a trade, enter perfectly, and then ruin it by closing too soon. They can't help themselves. They're addicted to movement. They don't understand that doing nothing is often the most powerful action in the world. The man who can wait is the man who profits. The man who can't wait becomes the crowd that buys too late and sells too early, forever trapped between fear and greed. There's another truth about sitting tight that most never grasp. It's not passive, it's active vigilance. When you're sitting, you're watching the market's behavior like a hawk. You're alert to danger signals, aware of abnormal moves, sensitive to shifts in volume and tempo. But you're not reacting, you're observing. It's the difference between a soldier who's firing wildly and one who's aiming patiently, waiting for the perfect shot. The market is the same battlefield. It rewards precision, not panic. It was never my thinking that made the big money. I once said, it was my sitting. People quote that line, but few understand it. Sitting doesn't mean you stop thinking. It means your thinking is complete. It means you've already done the analysis, made the decision, and now you're allowing time to validate it. That's the part the crowd can't do because they're never finished thinking. They're always doubting, second-guessing, adjusting. They never give their decisions the time to bear fruit. In the end, sitting is the purest test of a speculator's character. It demands belief without arrogance, patience without paralysis, confidence without complacency. It strips away all the noise and leaves you face to face with the only question that matters. Do you trust your judgment enough to let it work? If the answer is yes, then sit. Sit through the reactions, through the boredom, through the fear, and let the move unfold. The market doesn't reward effort, it rewards endurance. But even endurance has its limits. Every move, no matter how strong, reaches its end. The same patience that keeps you in must also tell you when to get out. Because the secret to sitting tight isn't just knowing when to stay, it's knowing when to stop sitting. And that's the final lesson. Learning to recognize the signs that the move is over, that the time for patience has passed, and the time for profit has come.